Hey there, everybody. Thomas Wood with Basecamp Trading. It is Thursday, April 27th, and we're going to talk a little bit today. Instead of focusing on price action like what we've been doing recently with the price action trading series, we're actually going to talk about reward risk and percent win, and why these two numbers are very important to any trading strategy that you're using. So what I always tell people and what I'm always teaching is you have to have a balance between reward risk and percent win. Reward risk is the amount of money that you make when you're winning trades over the amount of money you lose when you're losing trades. Okay, so if you make $200 on an average winning trade and you lose $100 on an average losing trade, you have a 2-to-1 reward risk. Now, what happens with a lot of retail traders is they think that all they have to do to be successful is they have to be right all the time. And that's not true at all. Okay, because if you're right, for example, I was just working with a guy that was right around 77% of the time. He had a 77% win rate. Okay, but he was still a negative trader. Okay, he was losing money consistently. And the reason is because his reward risk did not balance out that win rate. Okay, I worked with another guy that was in an 80, he was like an 84, 85% success rate. So he was almost on every single trade, he was making money. However, he was losing so much in the losing trades that even with all those winners, he still couldn't have a net profit. So what I always teach is you got to have a balance between reward risk and percent win. And there's not just one way or one number that works, because people always come and say, well, hey, Thomas, what's the number? What is the best reward risk ratio I should have? Or what percentage of trades do I have to win in order to be successful? And there's not any one way to trade. Okay. So what I want to show you here, these are equity curves from just a few of the traders I've worked with doing mentorships and doing workshops with in the past. All right. And I want to show you because they all have different equity curves. They're all making money, but they all trade completely differently. And they all have different reward risk and different win rates. So in this case, this is a good example of what a really good 2-to-1 or better reward risk ratio does for you. Instead of having that 1 step forward and 2 steps back downwardly in equity curve, this is a 1 step or 2 steps forward and 1 step back. Okay, this is David, and his equity curve is pretty good. This is just for trading bonds, okay? And all he's doing is trading one lots in bonds, and it's just nice winner. Okay, you have a loss. Nice winner. Okay, you have a loss. Okay, nice winner. And his reward risk is balanced with his percentage win. So you could have, for example, a 20 or 30 to 1 reward risk on average. So you're making 20 or 30 times what you're losing on your average winning trade compared to what your average losing trade is, and you have a 30 or 40% success rate, and you're still really good shape with your equity curve. Okay. Or you could have a 1-to-1 reward risk and a 75 or 80% success rate, and that's a really good equity curve. But it's all about that balance. So here's another example. This is Laurie's equity curve, and Laurie's is really smooth, really well. I mean, this is honestly better than my equity curve, but hers, she's very consistent. Okay, and her reward risk is a little bit lower, so she's got about a 1-to-1 reward risk, but she has that really high percentage win. Okay, and the next one, this is Dave, and Dave's equity curve looks awesome here as well. I mean, his is very steadily up, and the way he's trading, you can see right here, he has a 66% win rate and a 1.49 reward risk. So his average winner makes about 1.5 times what his average loser loses, and he has a 66% win rate, and you can see just how nice that equity curve looks like. Okay, and then another example is right here. This is Andres, and Andres has a really high reward, or a really high percent win, and about a 1-to-1 reward risk. He makes about $100 on his average winning trade and loses about $100 on his average losing trade. I mean, not in this case, but 1-to-1 reward risk. But he has a really high percentage win. You can see here out of, what's this? About 26 trades, he's had 3 losers. So he has a really high percentage win and about a 1-to-1 reward risk ratio. So keep in mind, when you're trading, it's all about that balance. And when you go through and you look at your trade plan and you look at your trade log, Start tracking what your percent win is and start tracking what your average reward risk is. Look at those two numbers, and then you'll know what you need to focus on. Do I need to focus on being more selective with the trades I'm placing? Or do I need to focus on letting my winners run further so I have a better reward risk, or cutting my losers off faster so I have a better reward risk? Okay, so that's all I have for you for today. I'll see you in the next video. I wanted to touch on this just because this is something that's often overlooked. People think that it's all about this indicator, all about this strategy, and really one of the most important fundamental principles you have to be successful as a trader is risk management. So that's why I want to talk about it a little bit today. So that's it for today. I will see you in the trading room bright and early tomorrow morning. Have a good one. Don't forget to click the link to subscribe. And until next time, happy trading.